There's an economic theory which suggests that low interest rates will squash the value of a currency. So last week's 0.5% cut in interest rates, in theory, will help push the Australian dollar closer to parity with the greenback, which of course can only be good for Australia's primary producers. After all, we export over 60% of what we produce, and the lower our dollar is, the more competitive we become. Now, earlier this year, we showed an ABC The Business panel of experts and their predictions about the dollar. Only one expert, Ord Minnet's Gerard Minnick, was forecasting the dollar to go below parity by the end of the year. Well, how do they feel now? Here are the tips after last week's cut in interest rates.
Today's 50 basis point rate cut by the RBA doesn't have a huge impact on my currency forecast, partly because I was expecting the cash rate to be down towards 3% at the end of this year, and also because in the second half of the year the main influence I'm looking to weaken the currency is actually commodity prices coming off rather than further dramatic reductions in short rates here. So 90 cents still looks okay.
Well, interest rates are certainly important, but the fact is, even with rate cuts, that differential between Australian interest rates and the rest of the world is still very high. It may be smaller, but it's still relatively large, and that's going to be a powerful support for the Aussie dollar.
Well, I'm probably going to lower that forecast to $1.05. I think if market sentiment shows that monetary policy is going to continue to ease, then that will put downward pressure on the dollar. But the fundamental story, I think, still one for the dollar to be above parity. The emerging markets, China and India, Brazil, still means that the Australian currency is going to be a strong one globally.
Well, after some near-term weakness, slower growth in the Australian economy, RBA rate cuts, which might see the Australian dollar drifting down towards parity, we still look for 105 cents for the Australian dollar at the end of the year. We think the world will be looking a bit better, and we think Australia will have steadied. So we still have that same forecast.
You're in a world where you'll probably cut some more. In the short term, that will probably hurt the currency, but fundamentally, I think we'd leave the currency forecast at around 101. It's more driven by what's happening to commodity prices and what's happening to China than it is about what's happening to interest rates.
Intriguing, isn't it? All those highly qualified experts, many of them with more degrees than a compass, and all with access to the same information and so many different opinions. We shall see which expert is most expert at the end of the year. Let's start the prices check with our largest real export, and that's beef. And the return to a full trading week met with a strong lift in buyer activity in the majority of markets. Restockers were very active, as were exporters keen to build up kill schedules through May. And to the surprise of nobody, most categories lifted. Exporters would love our weaker dollar, and they'll like it even more if that trend continues, and the wet weather also helped. So the week's action saw the Eastern States Young Cattle Indicator lift a fraction to close at $3.74 a kilogram. The live trade is midway through its second quarter quota to Indonesia, and producers are already getting the fidgets about the size of the next quota. There's every indication that there's a shortage of beef in Indonesia, but it's a guess whether that will matter when quotas are decided. Prices, meanwhile, are steady. Oddly enough, despite the quotas, Darwin export numbers are actually higher than this time last year. Lamb and sheep numbers are on the decline. April offerings were down 20% on March, with WA off more than 70% year on year, as producers there look to flock rebuilding. The indicator, which is for lambs 18 to 22 kilos, lifted 26 cents. Mutton continued its slide. To grains now, it's been a volatile week. Prices up and down as traders digest news of record yields in North America and ongoing speculation about crop volumes in just about every would-be exporting country. ASX futures finished steady on last week. There's a lot of chatter around about how dry it remains in Western Australia. Local canola prices lifted, even as reports strengthened about the massive area of canola being planted this season. Sorghum continues to fade. That's down $30 in just a couple of months. Chicago action saw wheat recover late in the week despite forecasts of a huge harvest. Corn is headed much the same way, with plantings in North America the highest in 75 years. So over the week, corn and wheat for July delivery lifted slightly above the just expired May contracts. And how about this? American soybean exports are up 480% on last year. Hopefully, I'll have time for that amazing soybean story next week. Now to New York, where two commodities of great interest to Australian farmers are really struggling. World cotton stocks are tipped to build to more than 14 million tonnes, up 55% on last year. And the Australian cotton crop this year will reach close to 4.5 million bales, an all-time high. And sugar, the word on world sugar supply is abundant, although there's a sniff of a weather scare in Thailand, a major sugar exporter. So both sugar and cotton prices have been on the defensive. It's been a good ride for some time for both commodities, but it looks to be fading fast. And finally to wool, where the market held up okay considering the mediocre quality of wool on offer. That's just a seasonal issue, mind you. China led the way again at auctions where the middle microns did best. So the Eastern Market Indicator closed up just under 0.5% at 1,170 cents a kilo clean. And that's the Landline check on prices.